Alright, so I am not a financial advisor. I'm not making this video to give you financial advice, and this is purely for entertainment purposes. That aside, I would like to discuss something that I have been doing personally myself that I think is timed really well for other people to get involved in that may not even be aware that it exists as an option in the cryptocurrency market. It should come as no surprise to anybody that right now, cryptocurrency is in a bear market and everybody is saying that the market has crashed. Again, doom and gloom, it's the end of crypto, Bitcoin is never recovering, the alts are never recovering, they're never coming back, everyone's lost all their money. But we all know this has happened multiple times over the last decade and it keeps on bouncing back. So if you are like me and you anticipate that it will bounce back, you might have the next question of what's going to bounce first. Is it going to be Bitcoin or is it going to be the altcoin market? Now, since I've been investing in cryptocurrency, I've had a tough time trying to make those calls. Sometimes I've made the call right, sometimes I've made that call wrong, and I've always wished that maybe I could get on both of them at the same time. And you can. Almost. And you can do that using collateralized loans. Now, the way that works is you actually put an asset up for collateral and you borrow a different asset against that so you can spend it. So I could go take my $1,000 worth of Bitcoin and I could put it in one of these platforms and they will give me back money. I can go buy $1,000 worth of groceries if that's what I want to do with it. Now, that's probably not a very good idea because the interest rates are going to be a lot higher than whatever your credit card or personal loan is if you actually need a loan. But there are definitely some advantages to doing this. So, first of all, where do you do this? So there's a couple of places. Well, there's actually a lot of them. Places like Aave, Gemini, Nexo. CoinRabbit's the one that I'm going to discuss today because it offers a fairly high loan-to-value ratio. That is that the amount of collateral you put up, they give you back a significant portion of that in your loan currency. You can actually take up to 80% of your collateralized value back as your loan with CoinRabbit. Now, there's no KYC requirements. That's know your customer, so you don't have to fill out any forms. There is no approval. Literally, all you do is you deposit your Bitcoin and you get back your currency of choice. They don't offer every currency to get that back in. They do offer a loan against your asset of many different forms, though, but your receiving asset is going to be one of the Tether coins, or it's going to be Bitcoin, or it's going to be Doge, or it's going to be Ethereum. Seeing as we are in a bear market at the moment, if you are anticipating it going up, which would be the only reason you're probably going to be considering buying at the moment, you are probably going to be wanting to deposit Bitcoin or one of your altcoins as your collateral, and you're probably going to be wanting to borrow a stable coin. Well, how can you buy both Bitcoin and your altcoins at the same time to hedge your bets? Well, it's not even hedging. You literally buy both of them at the same time with the same money. Almost. What you can actually do is you can take, say, $1,000 worth of your fiat currency and you can use that to purchase Bitcoin online on your platform of choice. And then you can go to one of these places like CoinRabbit and you can deposit that Bitcoin onto their platform. And then you choose your asset of choice in which you want to take a loan against and you choose the amount that you want collateralized. So you can do 50%, you can do 70%, you can do up to 80%. So for every $1,000 in, that means if you borrow at a loan-to-value ratio of 80%, you can actually take out $800 worth of your loan currency. So that means you could buy, say, $800 worth of US dollar Tether. Now, I use USDT on the Tron network because it's cheaper to transfer fees. Well, at least on this particular platform it is anyway. You can choose whichever one you like yourself. But using the Tron network, you actually have a lower interest rate repayment that you have to make. Now, what is the loan term? There is absolutely no loan term. You can keep this loan perpetual for the rest of your life if you do so desire and never pay it back, so long as you make the interest payments and so long as the price of your collateral does not fall to below your liquidation point. So, is that expensive? Yes, it can be. If you were going to buy Bitcoin and then put it up to loan to buy, say, US dollar Tether and buy more Bitcoin with that, you would then be paying 14% per year in interest, which means that you would need the growth of Bitcoin to go up more than 14% in order to make up that shortfall. Now, there is a way that you can do it that you don't actually have to dig into your pocket to pay the interest payments, though. So if you were to buy a proof of stake coin which offers staking and it incentivizes that staking via a staking reward, in my case, Zilliqa is what I'm very bullish on. I think they're going to do very well. And they have a staking reward which is greater than 14%. Actually, at the moment, it's 14.15%. So it's only marginally larger than that, but it is larger. So that means that if I put up my $1,000 worth of Bitcoin into the platform, I take my $800 USD Tether loan, and then I convert that Tether into Zilliqa, and I deposit that on Zilliqa's, and I deposit that into my Zilliqa wallet and stake that, and receive my 14.15%, which I can take out on a daily basis if I do so desire. I can then keep that 0.15%, and I can repay my loan with the 14%, and I can continually accumulate more and more profit over time. Now, there is a caveat to that, and that is so long as the value of Zilliqa does not drop below the point that you originally purchased it. If it does, you're going to have to dig into your pocket a little bit in order to service the interest rate on that loan, because the interest rate on the loan is not going to change, and the interest rate is charged against the amount that you borrowed, which is going to be in your stablecoin. Hopefully, the price of the cryptocurrency that you borrow to purchase goes up in value, and then any interest that you're making from your staking rewards also is going to go up in value with that, which means that you're going to make greater profits if that happens in that example. Now, that almost sounds like free money, doesn't it? You're not getting 2 to 1 on it, so you can't invest $1,000 and buy $2,000 worth of cryptocurrency, but you can invest $1,000 and purchase $1,800 worth of cryptocurrency, which has a potential to do very good things for you. Now, the downside is it has potential to do bad things to you as well. When the market goes up after you've made your purchase, you're obviously going to make 1.8 times the amount of money that you would have made if you hadn't taken a loan. If the market goes down, however, you're going to lose twice as fast, because now instead of losing on one currency, you're going to lose on 2 currencies. But you probably knew that anyway. Hopefully you knew that anyway. And if you didn't know that already anyway, you need to go do some more research outside of this video before you go invest in anything. Please do your own research on absolutely everything. And don't trust anybody on the internet telling you what you need to be doing, should be doing, could be doing. Do lots and lots of research if you are new to this space. In addition to that, there are a couple of risks. Lending to a platform, or lending from a platform like this, putting up collateralization, you are taking your money off of the blockchain. And you've all heard the mantra before, hopefully you have, not your keys, not your crypto, which is true, and it should ring true to everybody. If you are collateralizing $1,000 at 50%, they could give you your 50% and they could go belly up, or they could get hacked and all the money on the platform be stolen, or the government could come and regulate and they shut down. Who knows what might potentially happen in the future. And then you're going to lose the difference between what you have borrowed from them versus what your collateral is actually worth. Potentially. Maybe you won't. Maybe even if they do go belly up, they have a strategy for that. I don't know, but you can't guarantee that that is going to be protected if something goes wrong. But taking an 80% loan to value ratio, your risk is somewhat mitigated, because the most you're going to lose is that 20%, because if that were to happen, you obviously would not have to repay your cryptocurrency loan to them. In addition, you would have the loan that you took out as well, which may even be worth more than you put in at the time that that potentially does happen, which, fingers crossed, hopefully it does not happen. But we have seen a few platforms go belly up during this last bear market. Platform seems fairly sound though, because they're paying at 8% APY to people that are investing in, and they're charging you 14%. So there's a fairly big gap in the middle there that they are actually able to take as profit, and the business overheads to them seem like they're fairly low. So it is a serviceable operation to run. It looks like it's profitable on the surface, and it would seem foolish for them to go and do a rug pull and run away when there's potentially significantly more money to come from keeping those loans serviced. There are other risks. If the market tanks and it takes you below your margin call value, then you will lose your collateralized asset. What that means is, if the price of Bitcoin is $10,000 and you have an 80% loan ratio and it drops below $8,000, you're going to get liquidated so that they can make sure that they keep your collateral and don't lose any money, so they're never exposed to risk of the market moving. Your collateral is only collateral while it's worth more than the liquidation figure that they have given you at the time of taking the loan. You can get around that by taking a low loan to value ratio, which means you can take, say, a 50% loan, which means that the price of Bitcoin or whatever your collateralized asset is would have to literally drop by 50% or more before you hit your margin call value. Or you can monitor it and make sure that if the price does start dropping, you top up your collateral, or you could start repaying your loan if the price does start dropping. Any of those things will potentially mitigate the potential for liquidation. Now, liquidation isn't necessarily all that bad either in this case. It's not like margin trading on a platform where you're going to lose potentially significant amounts, where you're borrowing at 300 to 1 and it goes past your liquidation point and you just lose your entire portfolio. If you get liquidated, you still obviously keep your loan. And if you're borrowing at 80%, then the difference between your loan and what you have borrowed is only a 20% total loss. Now, if you were to sell your crypto rather than be liquidated at that point in time, you're going to make almost the same money anyway. There is actually a 5% gap. So they're going to take 5% of whatever the value of your collateral was at the time you put it up as collateral, and they're going to take that off the top before you hit your margin call point, which means that you're exposed to 5% risk effectively. Now, if we have a sudden drop and the price of Bitcoin goes from, say, $10,000 to $5,000, then you're going to whiz right past your margin call point. But it's actually going to end up saving you money, because you can now sell whatever asset it was you purchased with your loan, buy the Bitcoin back at a cheaper price, re-collateralize it, and then repurchase whatever your asset was that you purchased with it originally, and you will now have more of it. So if the market tanks more than 5% past your margin call point, it actually saves you money. So there's a little bit of risk there, and there's a little bit of an upside there as well. So that could potentially go either way, but it's something that you need to be aware of if you are going to invest on this kind of platform. The interest rate is rather high compared to, say, getting a loan with a credit card provider or a personal loan, which, I mean, Reserve Bank interest rates at the moment, while they're going up, we're still talking like, what, 1% lower, depending on what country you're in. The loan repayments that you're going to be making to a decentralized finance loan on specifically CoinRabbit is going to be 14%. So that's quite high. So if you do have a plan to offset that, you either need to plan on that being a fairly short-term loan, or you need to have a game plan where you're investing in a proof of stake coin that pays staking rewards, or you plan on investing in a liquidity pool which is paying more than 14%. There's lots of options that do pay more than 14%. I'm not going to tell you what's good for you. Do your own research. Lots of them are not good options. Some of them are fantastic options. So make sure you find the good ones and don't just go throwing money into garbage. Now, the upside, if the price of Bitcoin jumps from $10,000 today up to $20,000 tomorrow, then all of a sudden you've just doubled the value of your collateral. If the price of your altcoin doesn't go up, well, that's kind of why we wanted to do this in the first place, so we could bet on both at the same time. If the price of your altcoin goes up but the price of Bitcoin doesn't, you could potentially sell half of that altcoin, pay off your loan, have no loan now, and keep the balance of your altcoin. And that becomes free money at that point. Or both could go up at the same time, which generally they kind of correlate. One tends to go up more than the other. But if the alts go up and Bitcoin goes up, well, you've just almost doubled your potential returns on what you were going to make if you only kept your money in Bitcoin or only kept your money in altcoins. So there's a very big upside to offset the potential downside. That is if the market moves up, though. Again, do your own research. I do think the market is going up, and very soon, but that is for you to determine and everybody else to determine on their own. The other upside is, because there are so many options to earn more interest with that money via, or earn greater staking rewards, or earn greater returns from liquidity pools on other platforms, because there are lots of options that do return more than 14%, you can effectively have a $0 repayment loan, or at least $0 out of your pocket, because what you are returned from these other places can service your loan for you. So that is a massive upside, that you can borrow money, have that money make more than the interest payments cost, and you never technically have to repay that loan out of your own pocket, and you could keep that going indefinitely because there is no loan term. That's a pretty big upside. The other upside is a taxational upside. So if I was to go spend my Bitcoin, for example, and I go cash it into a fiat currency or just into any other token, I am going to pay the difference between my purchase price and my sale price is going to be taxed. If instead of spending that collateralized asset, though, you put it up as collateral and you are loaned a different token and you use that token to make your purchase, there's no realized gain there, and there is no taxational implications, unless, well, afterwards, if the price goes up, there is taxational implications at the time that you dispose of that asset, or if it goes down, you could make the loss as well. But there is Also a very big plus side in the fact that your repayments now could become tax deductible depending on the purposes of that loan. If you borrowed that loan for a profit-making intent, you could now potentially deduct those repayments from your total income for the year and offset some of the other gains as well, while you are potentially still making more money on your other asset, as long as it remains unrealized profit. So that's another huge benefit, and it's another reason why people might look at doing this. Now, if you do get liquidated, that becomes a taxable event. Again, this is not tax advice either. Go speak to an accountant about these things, but something else that you might like to look into a little bit more is the potential tax benefits that can arise from taking a collateralized loan instead of just selling the asset to buy a different asset. There is absolutely no KYC requirements. KYC is know your customer. It's the forms that you need to fill out where you need to put your name, your address, so that way the tax department knows who you are. If you have cryptocurrency which you have managed to get hold of through means that haven't had KYC, then you can still remain completely off-grid by using platforms like this, being that they're not collecting any of your information. Now, if privacy isn't your main concern, the other upside to having no KYC requirements is that the loan is instant, because there is absolutely no approval criteria. You don't have to prove that you can repay the loan. You don't have to prove who you are. They don't really care, because they have your collateral available and they know that your collateral is currently worth more than they have loaned to you. So they know they're going to get their money back from you one way or another. And if you don't repay it, they're just going to sell you collateral. As long as the collateral value remains higher than your liquidation point, they will keep your collateral open, and you can keep servicing the loan with the interest repayments and keep that loan open indefinitely, which means until the end of time. So if you can find a way to make more money from that than 14% indefinitely, then keep that loan open indefinitely and you will continue to grow your total wealth. It's just a whole new way of compounding your money. So if your intention is to invest in a proof of stake coin and get a staking reward, and that staking reward pays more than the 14% that this platform charges you, then keep it open indefinitely, because as long as the value of that token isn't going down, or you don't anticipate it to go down, and you're not anticipating the price of your collateral to go down, and you don't plan on selling your collateral anytime soon, or you don't need it, then just keep the loan open indefinitely, because there is no other reason to sell if you're actually making more money from that money being on loan than you're having to pay to keep the loan open. Just another way of utilizing your money to work for you, to compound your money faster, because that's the aim of the game, is you can spend your money once, and you can make a static rate going over and over and over, but you never really grow your wealth too fast doing that. The only way you're going to grow your wealth is by compounding it, and compounding the compound, and then compounding the compounded compound, and then you can grow your wealth very, very fast. This is just another way of doing that. I'll probably be making a whole lot more videos on less understood aspects of the cryptocurrency market and space in general. This is just one of them, and it's something that I think is of a timely manner right now while we're on the precipice of potentially having another bull run. I'm not saying that we're going to go up straight away, but I think we're either at the low at the moment or we're very close to it. So now is around the time you want to start timing these sorts of things, because it doesn't make a whole lot of sense to take a collateralized loan when the market is at its peak to buy another token, only to watch the value of both of those things go down. So these sorts of things you want to do while the market is low, and that is how you can grow your wealth with a slow moving market a little bit faster. I'm Rocket Rob, and I'll see you next time, hopefully. Maybe. Oh, of course I have to say, make sure you click like and subscribe. This may be the first video, but it's going to be the first of many videos. Hopefully you gained some knowledge today. Good luck, and happy investing.